Hello, and thank you everyone for joining us for today's 2013 Top Issues webinar series. My name is John Kuhl, Public Affairs and Media Manager at the National Conference of State Legislatures, and I will be moderating today's webinar. Each year, NCSL develops a list of the most pressing and important concerns on state legislative agendas. Today, we have a panel of NCSL issue experts who will be discussing state budgets, taxes, and jobs. Our panel includes Arturo Perez. Arturo is the Program Director of the NCSL Fiscal Affairs Program and has been with NCSL for over 22 years. Arturo is joined by Todd Haggard. Todd is a Policy Specialist in NCSL's Fiscal Affairs Program and has been with NCSL for 4.5 years. Following the presentations by our panelists, we will have a question and answer period. To submit a question, you can use the chat feature that's on the right-hand side of your screen. We'll be trying to answer as many questions as we can. Thank you for joining us, and with that, I'll turn it over to Arturo.
John, thank you for introduction. Also, and thank you everyone for joining us this morning or afternoon regarding the latest state or NCSO webinar, which is, in this case will cover budget, taxes, and jobs. I'll go ahead and begin the presentation this morning by providing a quick overview of the latest state budget update report survey we did of legislative fiscal officers. In general, the situation for states is that state fiscal conditions are improving, their year-end balances are rising, and there's very few budget gaps to report from the states. Additionally, or at the same time, performance has been uneven, and state budgets remain vulnerable. That is to say that there's concerns about federal deficit reduction action. There are spending pressures still in play out there for the states in areas like Medicaid, and the economy continues to perform rather sluggishly for most states. Our latest survey was conducted in the fall of 2012 and captured the early months of fiscal year 2013 for the states. One of the questions we asked was in regards to FY 2013 state tax collection performance. As you see from this slide, we have information regarding the performance of personal income, sales and use, and state corporate income tax collections. Through the first few months of fiscal year 2013, as you can see, in most categories, or in these all three categories, personal income, general sales and use, and corporate income were at or above estimates, with some states indicating that they were actually underperforming. But for the most part, as you see, personal income tax collections, 13 states indicated they were above estimate, 15 were on target, and 13 were indicating they were below. And we have similar percentages or numbers for the other two. That is to say that in generally speaking, that the major categories of tax collections, personal income tax collections accounting for about 34% of state revenues, are in fairly good shape, although there are 13 states who indicated they were below. When we asked states why or to what degree their tax collections were underperforming, most states said that they were technically underperforming, but were relatively close to being on target. So the takeaway in this case is that states are reporting rather stable revenue performance across the board, but there are still some concern given the number of states that are underperforming. We also asked states regarding other taxes. That is to say, we've looked at severance, real estate transfer, and miscellaneous taxes to sort of try to get the most complete picture of state revenue performance through the early months of fiscal year 2013. On the severance side, there were 8 states indicated they were on target, but 9 states were surprisingly underperforming through the early months of fiscal year 2013. Real estate transfer taxes, which we've asked for the last few years since the housing collapse, are indicative of the housing activity in their states. And similar to severance taxes, 8 states indicated the real estate transfer taxes were on target, while 9 indicated they were below. A couple of states indicated they were actually exceeding the real estate transfer tax estimates for the first part of fiscal year 2013. In regards to miscellaneous taxes, we had several states that indicated that other taxes like gaming, cigarettes, tobacco were above estimate. such as in Nevada and Indiana. On target for miscellaneous taxes included property taxes in Washington State, gross receipts, and business and occupation taxes in Delaware and Washington, while a few states, including Oklahoma, indicated that motor vehicle tax collections were actually the lowest, and then New Jersey and Pennsylvania indicated that inherited taxes were actually underperforming for the first few months of fiscal year 2013. This next slide provides the latest information we have, or essentially summarizes what happened as far as 2012 state tax changes are concerned. 2012 was a relatively low-key year for major state tax changes across the U.S. In fact, we only had 3 states indicated that they had tax increases of more than 1%, while 3 states indicated they had tax changes that were equal to more than 1% of prior year tax collections. So all in all, on an aggregate basis, states raised the net change in terms of tax changes was $4.1 billion, or positive $4.1 billion, representing about 0.5% of prior year tax collections. Much of that has to do with what happened in California when voters in November approved Proposition 30, which will raise about approximately $8.5 billion annually in new revenues. In prior year before that, or in 2011, states actually reported a net tax decrease of about $2 billion, but in 2012, the net increase, or the net result, was an increase of about 0.5% in new revenues across the U.S. Kansas was one state that did stand out in regards to the tax reform, or the major income tax reform package that was approved by the legislature last year, in which they result in about $250 million reduction in taxes in the current fiscal year, FY 2013, and it will grow to about $850 million change in FY 2014, or next fiscal year, representing about 11% of total tax collections. So Kansas was one of the states that had major tax changes this past year. We also asked legislative fiscal officers their outlook for revenues through the remainder of the fiscal year, or through June 30th of 2013 in most cases. When the responses varied, we had most states, 33 states and D.C., indicated that they had a stable outlook on revenues. That is to say that they expected revenues to meet their forecast by the end of the fiscal year. 6 states actually indicated that they were optimistic about their revenue performance. That is to say that they thought in all likelihood they would exceed their budgeted forecast for fiscal year 2013 before the end of the fiscal year. 7 states indicated they were concerned, and 4 states actually indicated they were pessimistic, meaning that they thought there was a high likelihood they would not meet their forecast by the end of the fiscal year. Those states include Alaska, Maine, New Jersey, and New York. 2 of those states were impacted by Hurricane Sandy back in October of 2012. The next chart is the same information, but presented across the U.S. in terms that you can see where your state falls in line with the question of the revenue outlook for the remainder of the fiscal year. No concern there. The stable, or the horse head in this case, is simply the best graphic we could find for expressing what stable means. So no concern there in terms of what and if you're concerned about what the horse head means in this case. But you can see there is a variety of, or there's no real pattern across the U.S. The largest component, or the largest number of states, were expressing that they had a stable outlook for the remainder of the fiscal year. In regards to the question of spending overruns in FY 2013, there was a larger number of states reporting that there were cost overruns through the early part of the fiscal year compared to a year ago. But at the same time, in total, there was only 18 states that indicated they had spending overruns for the first months of fiscal year 2013. Medicaid or other health care programs represent the largest component at 10 states compared to, say, 6 at this time last year. and 20 2 years ago. So the situation has improved relative to a couple of years ago, but at the same time, there are still a number of states who are indicated that Medicaid or other health care programs continue to be an issue in which they have to go back and either make some adjustments or come back with supplemental budgets to address their shortfalls in those programs. Education is an area in which a few states indicated they were over budget, including both K-12 and higher ed. Corrections, only 4 states indicated that they were over budget for the first few months of fiscal year 2013. Those include Idaho, Maryland, Mississippi, and Vermont. A special note that a couple of states mentioned was that, especially those western states of California, Montana, and Wyoming, was that they indicated that fire suppression costs were over budget due largely to wildfires this past summer. So that was an additional over budget or expenditure that was over budget for many states because of the fire season last summer. We asked legislative fiscal officers as well to summarize their current state fiscal situation in their own words. And we took the information, it was an open-ended question, and basically created a word cloud, which the word cloud basically is the more the word is referenced or mentioned in the responses, the larger the font or the larger it appears on this slide. One word stands out more than the other. That is stable, followed by slow growth, which basically summarizes the situation in most states. We have a situation that basically summarizes the current fiscal situation as one in which it's slow go, stable, improving. There's some budget gaps, but there's still some cautious optimism about the rate of growth that's taken place. So if you look up at this slide, these words probably describe your state fiscal situation, given that we were talking to the legislative fiscal officers just a few short months ago. Again, we asked this question repeatedly, so it does evolve and change, especially compared to when we asked this question just a few years ago in the midst of the Great Recession. There was a much greater degree of pessimism being related to us by fiscal officers, and it's now one in which stable appears to be the dominant description for most state budgets at this point. This next slide provides sort of an answer to the question, which is how have state general fund revenues grown in this recession, or out of this recession, compared to previous recoveries? The assumption was that, in fact, that state revenues have grown slower than past recoveries, and the responses were that 27 states indicated that they were below their historic norms for coming out of a recession. 10 states indicated they were in line. 4 states indicated they were above their recoveries from past recessions. But Arizona, for example, said that given the deaths that they encountered from revenues or their drop or the collapse in revenues, that the rate of growth coming out of this hole that they were in exceeds prior recoveries. But at the same time, they said it's all relative. They've not had a drop in revenues like they've experienced in the current recession or the most recent recession. So all in all, it's a situation that states have had a tougher time coming out of the Great Recession than they've had in previous recessions. We asked another question which we've asked several times over the last few years, and this is probably the last time we'll ask this question, and that is, what is your projected return to peak revenue collections? 42 states indicated they had reached a peak revenue collections back in fiscal year 2008. So most states when we talk about a return to peak, we're talking about a return to FY 2008 general fund revenue levels or collection levels. And by the close of FY 2013, just about a little over half of states will have reached that point, which means the other half of states still have some time before they get back to that level. As you can see, we have states that were projecting all the way out through FY 2018. That, in fact, is Arizona. that does not expect to get back to peak revenue collections until then. But at the same time, there are 11 states that said that it's not within their forecast horizon as to when they will be returning to peak revenue collections. So this sort of gives you an idea of the long, slow recovery that has affected states and that states have had to deal with over the last few years in regards to the impact that the Great Recession had on state revenue. This is the same information presented in map form. Gives you an idea of how the return to peak is playing out across the U.S. Alaska and North Dakota are both in a different category than most other states in that North Dakota never had a peak year. In other words, each year, because of the energy development in that state, has had the ability to grow its revenues, and they were unlike any other state in the sense that they were not affected by the Great Recession. Alaska indicated that their return to peak is probably not applicable in this case because of the high energy prices and production levels in Alaska at that time, and they may not be able to match that again. We also asked the state fiscal officers what were likely to be the top fiscal issues in their 2013 sessions that all states are currently under. And as you can see, we had multiple issues that were reported by the states. One that stood out more than any others was Medicaid. 34 states indicated that Medicaid was going to be the top fiscal issue for 2013 sessions, followed by education, pensions, as you can see the others, including transportation, federal budget, just the budget in general, and taxes. So these are probably issues that your state legislature is currently dealing with as we ask states to sort of identify the top fiscal issues that would affect them or that they would have to deal with during their current session. In summary, we've got a situation in which state revenues continue to improve across the board for the most part. Budget caps are rare. In fact, for the first time in several years, we did not ask states the size of their state budget gaps. And spending is relatively stable. That is to say that states are managing their spending within their projected levels. And at the same time, this has provided states an ability or greater flexibility to deal with the budget. They've in recent years, especially in fiscal year 2009, fiscal year 2010, states were dealing with very sizable budget gaps and had far less flexibility to deal with their budget situation than they currently are able to deal with at this point. At the same time, the performance has been uneven. There are some states that have not had as robust growth as others. Medicaid continues to be an issue for states as we move forward, being a top issue for state legislatures. Federal actions are the big question mark for many states in regards to what will play out in Washington, D.C., and we all are watching that very closely. Unemployment levels continue to be at high marks across the U.S., some states still in double-digit ranges, and slow revenue growth that we've seen coming out of the recession continues to be a common situation in so many states. That is to say that revenue growth has not been strong. It has been slow and steady, which is states will have said is much better than they were just a few years ago. But at the same time, revenues have not been able to grow strongly in any of the major categories of states or the major areas of taxation. So with that, I will complete my presentation on the latest state budget update report and hand it over to Todd Haggerty for his presentation. Thank you.
Thank you very much, Arturo. The last 2 points Arturo made there about unemployment levels and slow revenue growth provide a nice context for when talking about state efforts to create jobs. Given those two considerations there, states have put a strong emphasis on trying to foster job creation in their states in order to, one, bring down that unemployment rate and to help balance and bring some stability to state revenues. Now I'm going to talk about a number of different economic development or job creation strategies, but by no means is this fully comprehensive or exhaustive of all the measures states have pursued in order to create jobs in their states. But again, I think it provides a somewhat of a decent overview of some of the strategies that states have undertaken. Now, we all know that states have a number of tools available to stimulate job creation, and most experts, agree that, while the state's role is limited in some respects, they can play a strong role in fostering economic development in the states. Historically, states have devoted a large chunk of their economic development efforts to luring factories and other types of businesses to relocate within their borders. These efforts can be controversial, not only because as states become more spendthrift, and they've had a reduced amount of revenues in order to use, but these efforts can also be seen as damaging to the national economy or pitting one state against another. Of course, these efforts still move on and from one state to another, and throughout the recession, we have seen a little bit of a change. That state action has been more aimed at job creation, and that is related to tax cuts and job creation incentives rather than trying to lure or, as the old phrase goes, chasing smokestacks. So please keep in mind, as I mentioned, these are, a number of diverse perspectives, and that the proper role of government in economic development is one that, as the debate continues to move on. But this is, again, I'll just talk about a few different strategies. I'll start first here with some business tax changes. Last year, only a few states made significant cuts in general business taxes. However, reforming business taxes is one of the trends we have identified when analyzing all the tax changes enacted in the states over the past 4 years. Many of these changes have been enacted with the goal of lowering the overall business tax burden in order to have a more competitive state business climate. This slide here highlights some of the tax changes enacted last year in 2012 legislative sessions. For the second year in a row, Florida raised the corporate income tax standard exemption. In 2011, it went from $5,000 to $25,000, and last year it went from $25,000 to $50,000. New York reduced the corporate income tax rate for manufacturers for 3 years by lowering the rate from 6.5% to 3.25%. Lawmakers also approved a 1-year corporate income tax credit for job retention and new youth jobs credit of $500 per month per employee. Pennsylvania passed the Resource Manufacturing Tax Credit as part of the 2012-2013 Budget Act, but the credit goes into effect from 2017 to 2042. This credit was passed in order to attract Shell and future petrochemical companies to build plants in Pennsylvania. These plants would convert natural gas in the Marcellus Shale formation into ethylene. Again, to qualify for these new jobs tax credit, a company must make $1 billion of investment and create at least 2,500 new jobs. The tax credit also authorized the 5-cent per gallon tax credit for ethane brought to the manufacturing of ethylene from 2017 to 2042. There is no cap on the credit, so the revenue impact remains undetermined, and these credits are only allowed to offset about 20% of tax liability in a year. These credits can be sold and transferred, but they have to be offered up to other companies up to 50% of the taxes. Again, those may be offset, but they cannot be resold after that. Looking back, 2011 also had numerous changes as far as business tax changes as well. Michigan eliminated business tax, or its MBT, in 2011. The MBT was only enacted in 2007, but it proved less popular than the previous value-added tax that it replaced. The MBT was a complicated tax base of gross receipts and income, but it ended up only lasting 4 years. So in 2011, lawmakers replaced the MBT with a flat corporate income tax of 6%. The most interesting aspect of this reform was the elimination of all corporate income tax credits and deductions, except for small business tax credit. Also, as part of the general tax reform, they raised the personal income tax revenue by broadening the base and cutting rates. Just south of Michigan and Indiana, they also cut the corporate income tax rate, and this cut is being phased in and took effect this year. Looking west, Arizona cut its corporate income tax rate by 30% over 40 years. However, this does not begin to phase in until 2015. And North Dakota also cut its corporate income tax rate in 2011. Continuing on with these 2011 business tax changes, New Hampshire modified its business tax profits as it applies to certain legal entities as LLCs. And finally, Missouri enacted a 3-year phase-out of its corporate franchise tax credit. This change took effect in 2012. addition to tax cuts or tax reductions as far as businesses go, states have also used tax credits and incentives in order to spark job creation. Job creation can be costly, either in direct expenditures or towards incentives. So passing any legislation with a price tag is challenging, especially given all the fiscal difficulties that states have faced. Although challenging, over the past 3 years, a number of states have enacted new job tax creation credits. In 2012, Alabama and Wisconsin joined about 9 other states that offer tax credits to businesses that hire war veterans. And in 2011, we saw 3 new tax measures focused specifically on job creation. Arizona, Idaho, and Washington adopted new job creation tax credits. These 3 states joined several others that enacted job creation tax credits in 2010. And as you can see, the vast majority of states now have a job creation tax credit on the books. While the specifics of these credits differ, the common thread among the broad-based job creation tax credits is that these provide a benefit to the employer for hiring someone into a newly created position. A number of states also have creation tax credits aimed at employing a specific population, such as youth, the disabled, and veterans. And again, these are related to broad-based job creation, and they're available to employers for simply hiring someone into a new position. So, what are some of the variations that exist between these credits? Now, some of these credits require the employer to hire someone who is or has been drawing unemployment benefits. Others require the position to be filled to pay at least a certain amount or at least a certain amount of time. And some of these credits are only available for small businesses or businesses within specified industries. Generally speaking, these credits are awarded to help businesses regardless of its type of legal formation, so these credits usually apply to personal as well as corporate income taxes. Here are 3 examples of how these credits work in practice, as you can see on the slide. Each one of these examples is also subject to a statewide cap on the total amount of credit available per year. The provisions I listed for Arizona are those applicable to counties with large populations. There is a similar credit available for smaller counties. In California, deduction investment threshold and lower job creation is required as well. And deduction in California, again, may be taken for new employees hired. In Illinois, the credit was just extended. The original credit, which related to new full-time positions, was created by a business for jobs created by a business from July 2010 to June 2011, and sustained this 1-year time period and was granted to eligible small businesses a $2,500 tax credit. The credit has been reinstated and extended to 2016. Now, there are several other efforts as well, just besides tax credits. Many states have embarked on infrastructure spending and investment to create jobs. And these, again, can be those states that take on those 2 things, any sort of infrastructure deficit that a state might be facing while creating jobs at the same exact time. So many states have seen this as an opportunity to tackle 2 separate issues. For example, Illinois created one of the largest ones, Illinois Jobs Now, a $31 billion capital construction project that's taking place over 6 years. That's anticipated to create several $100,000 worth of jobs in this time period. And it's a combination of it's funded by a combination of state and federal debt and local matching funds. The state's $13 billion portion of the project was backed by tax increases and fees. In Iowa, there was an $875 million infrastructure spending program funded through bond issuance called Iowa iJobs. And then MassWorks is an infrastructure program that provides a one-stop shop for municipalities and other eligible entities seeking public infrastructure funding to support economic development and job creation and retention. Now, looking at a specific industry, Connecticut enacted Bioscience Connecticut, which is an $800 million program over 7 years that's expected to create over 3,000 jobs. This program involves several major capital construction projects and is coupled with the expansion of the higher education bioscience programs. The stated goal is to jumpstart the state's economy by creating jobs now and investing in long-term growth by making the state a leader in the bioscience industry. Now, these are just but a few examples of not only job credits, but also infrastructure spending. States have also sought to make the business of doing business easier in the states to spark job creation by trying to eliminate some of the red tape, if you will, or the hoops that businesses have to jump through in order to either start a business or maintain a business in the state. Now, this just looks at just two of the regulatory reform efforts that states have embarked in Michigan with the creation of the Office of Regulatory Invention, which is there. The goal is, you can see on the screen, to simplify Michigan's regulatory environment by reducing obsolete, unnecessary, and burdensome rules. And then in Ohio, we saw the creation of the Small Business, the Common Sense Initiative Office, which is a small business review process that's reformed the way businesses are regulated in order to help employers navigate state regulation. And again, one of the things that's coupled with the creation of regulatory reform is that states have also sought to make the entry point for businesses easier as well. So here you can see at least 14 states highlighted in the orange color here that have created online portals that provide a unified entry point for business owners to access information about state services, requirements for operating a business, and allowing companies to submit forms and applications, make payments, and complete other transactions as part of doing a business in each respective state. For example, the Kentucky Business One Stop, which was a bipartisan effort when it was enacted by Senate Bill 8 in 2011, it was created for business owners to access these state services and complete general requirements for operating a business in Kentucky. Additionally, this legislation requires recommendations to the General Assembly, both for the near term and long term, for goals that would increase the effectiveness of state services used by the business community. By reviewing the process and interagency sharing of data, officials hope that they can identify and potentially eliminate any inefficiencies between agencies and lower the cost of government, in addition to making the business of doing business easier. And in Virginia, they've combined the resources from 6 agencies into their Business One-Stop portal to accelerate and simplify the business process involving government, with the key to simply, a business would simply have to input the information once, and they can use that for all applications. Now, while several states have just embarked on this recently, like I mentioned, Washington's portal actually goes all the way back to year 2000. So while not a fully new phenomenon, this is something that there has been an increased effort by states to go down as far as making the regulatory environment and the ease of conducting business with the state that much easier. Now, the question that comes through all this, as we heard from Arturo, the context that states find themselves in with as far as revenue performance and the slow growth, is that states have to be very careful with these dollars they're spending. So the overall question is, does this program give away more than they're getting in return? So again, given the context that we're in and the number of tools that states have available to help stimulate jobs, it's important, and a number of states have emphasized the evaluation of these programs and have taken a closer look to make sure that they're getting their return on investment in respect to all these programs. Again, the key is state dollars are limited, but there needs to be an effort to help create some of these jobs. But again, it's all about accountability and evaluation as far as states go with their economic development programs. Now with that, I will pass it back to John Poole to help facilitate any questions that the members of the audience might have.
All right, great. Thanks, Todd. Like we said, we're going to try to get to as many questions as we can. If you can use on the right-hand side of your screen, there's a Q&A chat feature. Just type your questions in there. Our first question is, how are states preparing for uncertainties surrounding the federal budget?
In regards to that question, John, and it's a good question. We've been asking states for several years now, actually for the last year and a half, what it is that they are doing to deal with the issues relating to sequestration, the fiscal cliff. And there are actually several states that have taken various measures, whether it is in Virginia, where they put aside $20 million to deal with as a contingency fund to deal with the unknowns regarding federal deficit reduction, whether it's in Utah, where the state's agencies were asked to come up with contingency plans in the event that there was 5, 10, 15, 20% reductions in federal aid or federal funds to those to their programs. And so or in the case of Vermont, where rainy day fund was actually split up to address the issue of potential drop in federal funds to the state of Vermont. So there are several states that have taken actions, but most states, by and large, have not taken any specific actions at this point in regards to the possibility of state or federal cuts in aid.
All right, thank you. Our next question is about rainy day funds. Throughout the Great Recession, many states tapped the rainy day funds. Are officials now taking steps to rebuild them?
The short answer is yes. We've seen states rebuilding their rainy day funds. Our data here, the Fiscal Affairs program shows that rainy day funds have had a sort of a multi-year recovery, albeit at a slow rate, to the point that states are have added back into many other depleted funds. But one note of or significant note in regards to that issue is that 60% of all state rainy day fund balances are held by just two states at this point. Alaska and Texas account for about 60% of state rainy day fund balances. So it's sort of, when we take that out of the equation or take those two states' numbers, the overall situation for states is a little bit lower than what appeared to be the case at first glance, but it appears at this point, it does appear that state rainy day fund balances are continuing their slow recovery, much as we've seen sort of a slow recovery overall in regards to state revenues over the last few years.
All right, our next question is a two-parter. ITEP just released its most recent Who Pays report, an assessment of the distribution of taxes among the different income quintiles. What do you know about their methodology and the reliability of their data? And what are your thoughts about the impact of such profiles on sound budgeting and economic fiscal results?
Thanks, John. Well, while I'm aware of this report's release, I have not had the opportunity to read it yet. So I can't really comment on the methodology that was used or the reliability of the data. That being said, you can see, that states are looking, at across the country are looking at their tax structures. We've had numerous tax commissions across the states over the years trying to figure out, one, what brings stability to the state revenue situation given the large budget gap states have faced over the years, and also what's the most either equitable and at the same time what's also going to help spark job creation, economic development in the state. So again, I think this is something you can see playing out and from all ends of the spectrum across the states, and one that NCSL will continue to keep its eye on.
All right, thanks, Todd. Next question, what trends does NCSL see in regards to state economic development plans?
Thanks, John. Again, I think, going back to just the discussion of states looking at their tax structures, you see the various proposals that have been introduced this year across the states that states looking at it from, how do we improve economic development across states, again, with that creation of jobs. And then also, some of the things that I've touched on is, the tax credits and incentives for job creation, investing in infrastructure, and again, the aims of, implementing or some sort of regulatory reform, not necessarily just eliminating regulations, but again, making it easier for businesses to conduct their business in the states. So again, those are the main areas where we're seeing a lot of the efforts. Again, not limited to that. There are numerous strategies that states are using to help create jobs, but just a few.
Okay. Next question. It was mentioned that many states have provided credits and incentives to businesses to create jobs. What are states doing to ensure they are getting a return on their investment?
Yeah, as I kind of wrapped up in my presentation, evaluation and accountability is a crucial piece of state economic development programs. Are you getting the return on investment? Are you getting the bang for the buck? And, states with their tax expenditure reports listing all the tax credits, where the money goes, and how they're being used is one step. A number are also using penalty provisions such as clawbacks or recapture provisions with any of their tax credits or incentives. And then finally, some states have structured their credits or incentives where you actually don't receive it until you've met the anticipated goal, such as X number of jobs created and retained over a number of times. So again, it's contingent upon meeting some sort of goal before you actually receive the credits. And again, those are just a few of the methods and ones that, as we see states looking to make sure that taxpayer dollars are being used efficiently and for the greater benefit of the state as well. So just some of the methods.
Thanks, Todd. Next question, will the potential of an increase in the minimum wage, so I guess that's a State of the Union question, adversely affect state tax base? That's a tough question. That's one that, one that I think that was mentioned in the State of the Union address. We haven't really dove into that question here yet. So again, that's something that, that's, again, a lot of economic development or a lot of these programs, people have different opinions on either side of the spectrum on what the impact will be. So it's, again, something that, we haven't done any work on currently, but again, always check our website to make sure that we'll see what information we have, and we'll continue to look into this issue as well. Okay, has there been evidence of especially successful job creation programs?
Again, evaluation of economic development programs is an increasingly difficult field. You can find proponents or opponents on any number of these issues, whether it be a film tax incentive and the jobs or the industry that it's brought to a stage, or whether it's an infrastructure investment question as well. Again, the questions always remain, how many jobs did it create? Are they long-term or are they just temporary jobs? So again, it's one of those things where continued evaluation is the way states are going, and they'll continue to, I would expect, continue to put a lot of effort into making sure, again, that these tax dollars or these credits are being used in benefit the state.
Okay, thanks, Todd. Another jobs question. For states that provide a tax credit per job created, how do the states verify or audit that the job was indeed new employment?
Again, this is going to vary by state, but many have, very tough reporting requirements and documentation of the job, how long it was going for. And again, some of those states with recapture provisions can also be, well, if you created one job here, but another was laid off. Again, there are some definite tough reporting requirements that states have put into the language of these tax credits and incentives. That's just one key again, but tough audit, tough evaluation, and reporting requirements. That's just one step that states have taken.
All right, thanks, Todd, and we were going to end it there. Thank you, everyone, for joining us, and please take the time later today. We'll be emailing folks the survey, so if you could fill that out, we'd appreciate it. The next webinar in our 2013 Top Issues webinar series will focus on school reform, including resource reallocation strategies, efforts to improve educator effectiveness, implementation of Common Core standards and new assessments, improving school choice, and implementing new digital learning. That webinar will take place next Friday, that's February 22nd. Thanks again for joining us today.